Tesla once seemed unstoppable. Yet right now the numbers do not lie. The share price sits roughly 40% below its December 2024 zenith, deliveries have contracted for 2 consecutive years, auto gross margins have sunk to multi-year lows, and the vaunted regulatory credit gravy train has dried up. That snapshot alone would make any investor nervous, but the real story is more complicated and far more interesting. Which is why you need to stay with me, because in the next few moments we will move from current pain to the concrete conditions for a rebound, then to the brutal competitive reality, onto the macro headwinds that few people track closely enough, and finally zoom out to the 3, 5, and 10-year chessboard, where Tesla either re-emerges as a tech plus transport colossus or settles into the role of just another carmaker with a flashy logo. The immediate facts first. By mid-July 2025, Tesla traded near $315 a share, leaving its market capitalization just under $1 trillion, down several hundred billion from the late 2024 peak. Year-to-date performance stood at -22%, dramatically worse than the flak showing at General Motors and the 37% pop in BYD's American depository receipts. In concrete operational terms, Tesla delivered roughly 384,000 electric vehicles in the second quarter of 2025, a year-on-year slide of 13.4% and about 10,000 units short of Wall Street's already lower bar. Revenue measures follow the same direction. The 2024 calendar year was the first full year ever in which Tesla did not grow sales, and consensus expects an additional high single-digit contraction for 2025. Each one of those misses matters not only because of the lost dollars, but because the valuation has always assumed aggressive expansion, so flattening volumes instantly triggers multiple compression. That is why the stock sells off harder than revenue alone would imply. Now glance at margins, since Tesla once prided itself on industry-leading profitability. Price cuts that began in early 2024 to counter soft demand and competitive pressure have bled into 2025, crushing auto gross margins to levels reminiscent of pre-Model 3 days. Every time the company shaves another few $1,000s off a Model Y, investors celebrate potential unit growth but then sell when they realize that each incremental vehicle now carries thinner profit. Regulatory credit sales, which peaked around $4 billion per year, are effectively gone because new United States legislation bars the trading of CAFE credits among automakers. That direct hit to revenue streams eliminates a high-margin buffer Tesla relied upon for years. Put bluntly, the easiest money has vanished just as competition shoots up and customer incentives cool down. Stick around, because the next point is even more revealing: leadership risk. Elon Musk is both Tesla's superpower and its Achilles heel. Within 7 days of his July 7th announcement that he would bankroll a new political party, the stock lost roughly $150 billion in market value, as investors factored in the added distraction, potential brand damage, and fresh regulatory blowback. Large institutional holders privately complained that every detour into partisan showmanship crowds out time Musk could devote to manufacturing scale, autonomous driving software validation, or supply chain optimization. Some have even hinted to reporters that they will vote against the current board if no guardrails are put in place. At the same time, everyday shareholders still see him as the irreplaceable visionary who willed the company into existence, so any hint he might exit could also crush the stock. This is the leadership paradox. Musk cannot leave, and yet his extracurricular crusades are killing near-term sentiment. We will circle back to how that plays into medium-term recovery, but first, you need to understand the competitive onslaught. Chinese automakers, led by BYD, already outsell Tesla globally in electric vehicles and have momentum. In the second quarter of 2025, BYD posted approximately 607,000 EV deliveries, up over 40% year-on-year, while Tesla shrank. Chinese brands such as BYD, NIO, Xpeng, and Geely Zeekr now push into Europe with compelling range, flashy interiors, and lower prices, while lobbying Brussels for equitable tariff treatment. June data from Germany showed Tesla sales plunging 60%, whereas BYD quadrupled its base, underscoring how rapidly share can shift. Europe used to be Tesla's safest export growth arena, now it is a battleground. Meanwhile, domestic Chinese market share fell to about 7.5% for Tesla in the first 5 months of 2025, evidence that homegrown players can scale quality at price points Tesla struggles to match. Why does this matter? Because each 1% point of lost Chinese share translates roughly into $2 to $3 billion of annual revenue. Small numbers compound quickly when the addressable market is huge. Legacy Auto is no longer snoozing. General Motors doubled its EV output to roughly 46,000 units in the latest quarter, Ford is on track to launch an F-150 Lightning refresh with longer range, Volkswagen has committed $89 billion to electrification through 2028, and Mercedes plans to convert half its European output to EVs by 2026. Those firms carry deep dealer networks, existing brand equity, and balance sheets still fueled by profitable internal combustion sales, allowing them to subsidize early EV missteps that Tesla cannot afford. Analysts tracking dealership floor inventory observe that loyal Ford or Toyota buyers often prefer a familiar badge once battery performance approximates Tesla's, eliminating Tesla's historic tech halo as a purchase trigger. Within the next 18 months, nearly every mainstream segment will feature 3 to 5 non-Tesla EV options. Tesla's answer is a promised, low-cost vehicle, sometimes called Model 2, targeted at $25,000, but initial builds were supposed to start mid-2025 and are now delayed into early 2026 due to platform engineering hurdles. In an industry where model cycles span 5 to 7 years, a 6-month slip can translate into millions of units handed to rivals. Autonomy is Tesla's trump card if it works, but real-world progress is patchy. Waymo operates paid robotaxi service in Phoenix, San Francisco, Los Angeles, and Austin. Cruise aims to relaunch after its high-profile safety crisis. Apple, though notoriously secretive, continues to file patents indicating sensor fusion architectures that skip LiDAR cost constraints. Regulators are tightening oversight. The National Highway Traffic Safety Administration has opened multiple investigations into Tesla's autopilot and full self-driving performance after numerous accidents. Every incremental safety incident undermines public trust and provides ammunition for legislators keen to show they protect constituents. From an economic standpoint, Tesla's valuation implies significant revenue from future software licenses or robotaxi networks. Yet no jurisdiction has granted blanket approval for Level 4 widespread autonomy. Timing mismatches between promise and monetizable reality create valuation overhang. Stay with me because the macro picture will explain why even perfect execution on autonomy might not rescue near-term fundamentals. Macro conditions are hostile. Central banks across the United States, Eurozone, and United Kingdom keep interest rates elevated to stamp out sticky inflation. Average auto loan rates in the United States hover above 7%, nearly double pre-pandemic norms, elongating replacement cycles and discouraging discretionary upgrades like EVs. Consumer credit tightening shows up first in big-ticket items. In May 2025, the Federal Reserve's G19 report logged auto loan growth at its slowest clip since 2020. Europe fares no better. The European Central Bank warns that credit standards on household loans are at 12-year highs. High rates do two things to Tesla simultaneously. They dent affordability, pushing potential buyers into used vehicles or delaying purchases, and they raise Tesla's own borrowing costs should it need to issue debt for gigafactory expansions. Soft macro alone would be bearable, but combine it with policy shifts that remove or reduce EV credits and you have a 1-2 punch. The most recent United States fiscal package, nicknamed by critics the Pork Barrel Act, terminated Tesla's ability to sell fuel economy credits, instantly stripping out roughly $1 to $2 billion per year of high-margin revenue. Former President Trump publicly mused about rolling back broader clean energy incentives, which rattled markets because even the possibility of such moves influences behavior by fleet buyers right now. If a consumer is uncertain whether a $7,500 tax credit will exist in 6 months, many defer purchase. Political noise again converts into operational pain. Let us pivot to the bullish counterpoints, because any fair assessment requires weighing upside pathways. Tesla still owns the most recognized electric vehicle brand on Earth, has a vertically integrated battery supply chain, and runs the world's largest fast-charging network, which many competitors now license. Energy storage revenue, though modest today, is growing at double-digit percentages quarterly. For households and utilities trying to buffer intermittent renewables, Tesla's Megapack and Powerwall lines have credible cost advantages linked to in-house cell innovations. If that segment reaches scale, gross margins could approach software-like levels due to recurring service revenue for grid management. Then there is the possibility, remote but not zero, that full self-driving achieves technical viability and regulatory clearance sooner than skeptics expect. Even a limited self-driving subscription sold at $200 per month to, say, 5 million vehicles would create an annualized software revenue stream north of $12 billion, materially altering valuation math and dampening sensitivity to car sales cycles. Such a narrative explains why some outlier houses, notably ARK Invest, keep price targets above $2,000 in a late-decade scenario. What needs to go right for a true rebound? 4 variables dominate. 1. Product cadence. The cheaper Model 2 must enter production no later than early 2026, with a build cost low enough to preserve double-digit gross margin. 2. Leadership focus. Musk needs to publicly dial down polarizing extracurriculars and redirect time toward factory efficiency and technology rollouts. Signs of that could include fewer political declarations on social media and more verified hours per week logged at Fremont or Austin facilities. 3. Macro relief. A reduction of at least 100 basis points in average auto loan rates would resurrect deferred demand. Futures markets currently price mild easing by late 2026. 4. Autonomy deliverables. Even partial success at Level 3, hands-free driving across major highways would unlock higher average selling price and sticky subscription revenue without requiring full robotaxi approval. All 4 are individually hard. Together, they resemble threading a needle in gale force winds, but that is the bar needed to reawaken the hyper-growth multiple investors once paid. Watch the delivery trajectory quarter by quarter. quarter. If second half 2025 shipments stabilize around 400,000 units each quarter, Tesla will finish the year near 1.6 million vehicles, down but not catastrophic. An inflection in Q1 2026 back into positive year-on-year growth would establish a bottom narrative similar to what Apple achieved after its 2018 iPhone slump. Conversely, if unit decline accelerates, say deliveries fall below 350,000 per quarter, then fixed cost absorption worsens, margins narrow further, and Wall Street projections ratchet down, trapping the share price in a vicious feedback loop. Soft guidance or yet another production delay will be punished. Markets in this environment offer no benefit of the doubt. Now consider capital structure. Tesla holds roughly $27 billion in cash and equivalents, against about $5 billion in long-term debt, giving it one of the strongest balance sheets in autos. That war chest permits continued battery plant build-outs and strategic pricing flexibility, a luxury many competitors lack. For instance, Rivian and Lucid burn through billions per year and face dilutive equity raises. Tesla can weather longer storms, yet cash burn could spike if multiple gigafactory projects run concurrently while revenue growth is negative, so the burn rate trajectory becomes another critical KPI. Investors should monitor capital expenditures relative to depreciation. When CapEx consistently overshoots depreciation by more than double, free cash flow typically turns negative unless volumes jump. Tesla's CapEx in 2025 already trends above $12 billion annualized, but depreciation sits under $6 billion. A prolonged mismatch without volume recovery depletes the cushion surprisingly quickly. Examining sentiment, short interest now sits near 52-week highs, which can spark sharp squeezes on positive news. That dynamic supplies volatility more than direction. Bulls will argue that every downtick stuffs more spring into the coil, setting up a future rally if the company beats even one low bar quarter. Bears retort that momentum remains downward until concrete evidence of operational turnaround arrives. Options markets price elevated implied volatility around earnings dates, reflecting collective uncertainty. Retail enthusiasm has also cooled. Activity on platforms like Reddit's Wall Street Bets centers more on short-dated puts than out-of-the-money calls, a reversal from the meme stock heyday. When casual traders flip from cheerleaders to skeptics, it often signals a psychological shift that takes time to reverse. The political backdrop cannot be ignored, though nobody benefits from hyperbole. A future administration hostile toward clean energy subsidies would not outright kill EV adoption. Corporate fleets and state rules already push electrification, but it would slow momentum in the crucial middle-class segment. Tesla's risk is larger than Ford's here because Tesla lacks a profitable internal combustion fallback. On the other hand, bipartisan support exists for domestic battery manufacturing as a national security priority, which could offset softer consumer credits with industrial grants. Investors must parse each legislative headline for its specific balance sheet impact rather than react to tribal noise. Do not assume monolithic partisan trajectories. Policy often evolves through late-night negotiations where tax incentives morph instead of vanish. The nuance shapes whether Tesla's North American plants receive low-cost loans that materially lower weighted average cost of capital. Shift now to technology roadmapping because this is where true differentiation could re-emerge. Tesla continues to pursue its in-house 4680 cylindrical cell architecture targeting 56% cost reduction per kilowatt-hour. If the company hits even half that, it regains pricing power below rival pack cost, especially against legacy makers who still outsource most cells. Battery chemistries like iron phosphate erode the edge at the low end, but high nickel packs remain critical for performance models and heavy vehicles like Cybertruck. Speaking of Cybertruck, scaling production past 50,000 units annually will test Tesla's ability to master stainless steel exoskeleton manufacturing, a novel process. Each operational milestone in those programs feeds directly into investor confidence. Supply chain analysts should monitor Panasonic and cattle shipment volumes to Tesla to cross-check management guidance. Mismatches often foreshadow production misses. Energy storage, though overshadowed by autos, deserves a deeper look because it can mature into a margin lever. The global utility-scale battery market could exceed 1 terawatt-hour cumulative installations by 2030, according to Bloomberg NEF, and Tesla's Megapack already commands a brand premium in that expanding pie. Crucially, the unit economics differ. Profits arise not only from selling the hardware, but from software that balances grids, arbitrages electricity prices, and participates in capacity markets. Once deployed, storage assets generate service revenue for years akin to SaaS models that investors prize. If Tesla successfully bundles Megapacks with energy management software on multi-year contracts, the valuation narrative shifts from pure vehicle multiple to hybrid software infrastructure multiple, lifting the permissible price to earnings ratio. We will know the seriousness of this pathway when Tesla begins breaking out storage software gross margins separately. Transparent disclosure often signals confidence. Another potential catalyst lies in licensing. After Ford, General Motors, Honda, Volvo, and others announced they will adopt Tesla's North American charging standard, speculation arose that Tesla could command network fees much like wireless carriers charge roaming. The real monetary value depends on usage density and transaction fees, which at mere pennies per kilowatt-hour could aggregate billions at scale. The supremely durable aspect of this revenue is that once a driver depends on the network, switching costs soar, creating an annuity-like stream insulated from new car cyclicality. Management hinted during the first quarter 2025 earnings call that charging could become a standalone profit center by 2027. Keep eyes on utilization metrics. Tesla sometimes slips into shareholder letters when average energy dispensed per stall trends up, profit per site can more than double. With all these moving parts, what does the consensus actually model? Most sell-side houses peg one-year price targets in the low 300s, essentially flat from current levels. Their discounted cash flow frameworks assume mid-single-digit unit growth in 2026, auto gross margin recovery to low 20s by 2027, modest contribution from energy, and minimal autonomy revenue. Upside scenarios require 20+% unit growth or meaningful software upside, which analysts view as speculative. Downside cases look at continued volume erosion, margin stuck below 15%, and no material cost relief, pointing to valuations near $200 a share. That widespread underscores how binary the medium-term picture is. If you are an investor, position sizing should reflect that convexity. The stock can triple on optimism or halve on disappointment. If you are simply curious about whether Tesla will thrive, the honest answer is that evidence does not currently justify either euphoria or doom, only vigilance. Long-term, the electrification megatrend remains intact. Global EV penetration may reach 30 to 50% of new car sales by 2030 depending on region, and battery costs keep creeping downward, albeit slower than 5 years ago. Tesla's brand resonance, software stack, and manufacturing scale give it real competitive advantages that do not vanish overnight. Yet, those strengths no longer guarantee dominance. The brand's early adopter allure has matured, and future share will be earned on price, feature parity, and service quality. The same metrics that govern every mature consumer durable market. That is normal, not tragic. Think back to how personal computers shifted from Apple and IBM duopoly fantasies to a segmented ecosystem with multiple winners. For Tesla, the question morphs from whether it can maintain cult status to whether it can operate profitably in a brutal commodity game while monetizing software and infrastructure differentiators. That is a harder but still achievable task. So can Tesla ever recover? Yes, but only through disciplined execution, renewed focus from leadership, timely product launches, and a macro tailwind that loosens consumer credit. None of those are impossible, yet none are assured. Short-term rebounds require beating beaten-down expectations. Mid-term recoveries demand real strategic wins. Long-term triumph hinges on technology actually working at scale. A sensible observer, especially one skeptical of grandiose timelines, should demand proof every quarter and recalibrate views accordingly. Dismiss both the fatalists who claim Tesla is finished and the zealots who treat the company as destiny. Evaluate the numbers, watch the delivery curve, track margin repair, parse policy risk, and keep an eye on Musk's public calendar. The next 12 months will reveal whether the current slump is a temporary air pocket or the first chapter of permanent maturity. Either way, the outcome will reshape not just Tesla's valuation, but the path of the entire global auto and clean tech landscape.